The liquidity rotation model consists of two main concepts. The first one is the internal range liquidity to external range liquidity, and the second is swing highs and swing lows. These two concepts can be combined to give you a perfect reversal point with a very high win rate. We already know that when price is at an internal range liquidity, it will most likely target an external range liquidity. And when price is at an external range liquidity, it will most likely target an internal range liquidity. Now, in this case, the internal range liquidity is the fair value gap, and the external range liquidity is the highs and lows. Since we know that when price comes into an internal range liquidity, it will almost always target an external range liquidity. The next question is this: where should we take our entry? Should we simply enter at the start of the fair value gap, our internal range liquidity? That can be a good entry, but sometimes the risk to reward just won't be worth it. So the best two ways to take an entry from an internal range liquidity while getting a higher win rate and a better risk to reward are: 1, the use of a lower time frame confirmation, and 2, the use of what we call an overlap high or an overlap low. Today, I'll be explaining the use of an overlap swing point for entries. So, what is an overlap high or an overlap low? An overlap high is formed when a swing high overlaps with a fair value gap. This combination creates a very precise area for price to reverse from. For example, let's say you finished analyzing your higher time frame, and your drawn liquidity is above price. Then you see the market create a swing high, followed by an impulsive move to the upside that leaves behind a fair value gap. And that fair value gap clearly overlaps with the swing high. That becomes your overlap high. Now let's talk about an overlap low. An overlap low is simply the opposite. It forms when price displaces below a swing low and leaves a fair value gap that clearly overlaps with that swing low. That creates your overlap low. Once you identify an overlap swing point, whether it's an overlap high or an overlap low, you can set your limit order directly from that area and then target either the external range liquidity or a 1 to 2 risk to reward or your draw on liquidity, depending on the type of trader you are. Now, let me show you some real examples of this exact concept that played out in the live chart recently. You can go and check them yourself to verify. First, I'll start with the NZDUSD daily chart. I will always be an advocate for top-down analysis because it gives you a stronger framework for any trade you take. This setup happened on the 11th of November, 2025, by the way. Price closed above the previous day's high, which means we should expect higher prices the next day. And these two areas become our draw on liquidity for the day. Now, heading to the 4-hour chart, what can you see? I can clearly see a swing high that overlaps with the fair value gap, which makes it our overlap high. So, we set our limit order from that overlap high. Stop loss just below the fair value gap, and take profit at the external range liquidity. And as you can see, this trade would have bagged you a 2.7% win. Now for the last example, this is the GBPUSD daily chart, and this setup happened on the 23rd of September, 2025. Right here on the daily chart, we can see that price created this long wick and then started pushing to the downside. We also have a daily fair value gap, which I'm anticipating it to hold price and push it to the downside. So now heading to the 4-hour chart, we can clearly see a swing low that overlaps with the fair value gap. And all of this sits inside the daily fair value gap, which gives us another strong confluence. So we take our entry from the overlap low, stop loss just above it, and take profit at the external range liquidity. And as you can see, this was also a 3% win. So you can see how perfect this works when you align it with proper top-down analysis. Just because I've taught this to you does not mean you should go to the chart and take every overlap, high or overlap low you see. You need to align it with a solid framework and a clear bias if you want to get the best out of it. If you enjoyed this video, please give it a like and subscribe. See you in the next one.